Traders, in this video, I'm going to break down why you are doomed to fail as a trader if you don't follow these two principles. Now, it took me many years to find out the reason why I was failing. Had nothing to do with strategy, had nothing to do with education. I'd read all the books, done all the courses, practiced, back-tested, did what I was supposed to do, journaled, read Mark Douglas's books on mindset. I did all that sort of stuff, but I was still failing. And it comes down to two things, and it's to do with edge and letting your edge play out. And the second, I'll get to. So first and foremost, everyone in the trading space, books, mentors, everyone tells you to focus. You pick an asset, you pick a strategy, and you focus, and you're diligent. Before that happens, you have to backtest that strategy, right? So you have to make sure that it has a profitable risk to reward ratio and the profit factor is decent so that it's a long-term successful strategy. So people tell you to go backtest. So what do? You get your trading view out and you start to manually look over months, years worth of that strategy happening. Now, here's the problem in that. During that backtested, let's just say you had 100 strategies, 100 trades that you backtested. You won 60% of them, average risk to reward 1.5. Great, really profitable strategy. What people don't take into account is this. For that edge to play out in true fashion, in the real market, in real time, you have to take every single trade. Because if you start skipping trades, that's when your edge doesn't pay out and the probability doesn't work in your favor. Because you backtested on 100 strategies in a row, but if you have family obligations, work obligations, and you can't sit in front of the screen for 12 hours a day, 18 hours a day, whatever it is, then you're going to skip trades, you're going to skip entries. And those entries that you skip could be the trades that win, okay? So your backtesting is inefficient because you're swinging risk to reward in your favor in the backtest, and that's one of the main issues. Now, when you're trading manually, it's literally impossible to do that full time. It's literally impossible to sit in front of the screens and take every single position. What happens then is the strategy that you think is profitable that you're trading isn't actually a profitable strategy because you're skipping trades. I trade algorithmically, and one of the things that we do to overcome this is something called Monte Carlo analysis, where we randomly shuffle trades, order, and a bunch of other stuff to make sure that what we're trading is significant. So anyway, that's the first thing, is people think that they're trading a profitable strategy, which in essence they are, but they can't take all the positions necessary to let that edge and profit factor play out in their favor over time. Now, there was a really cool video. You can Google this or you can YouTube this. There's a video by a guy called Darren Brown from the UK, who's a mentalist. He's a magician. And he filmed live coin tossing. He said, I think it's something like 1 in 11,000 or 1 in 10,000 chances of flipping 10 heads or 10 tails in a row. And he filmed himself doing it, and you can see go into the bowl 10 in a row with multiple different cameras. What they didn't show you was the before bit. So to do that, it took him like 12 hours or something of failed attempts, and then obviously they cut it down to the last. So that just shows about probability, and that plays into exactly what I was talking about, that if you want to have probability work in your favor, you have to take every single position, and that's very hard to do if you have other obligations. And it's one of the main reasons why I prefer to trade algorithmically. So I'm not the one executing the positions or exiting for a profit or a loss. And only when you trade algorithmically can you base your trading on real data. So that's the first thing. The second thing, if you don't do this, then you're doomed to fail as a trader, in my opinion, is having all your eggs in one basket. Again, so many people say to focus on one instrument, learn how it moves, learn when the volume plays are, learn when the stop hunts are, and become a master of that asset and that strategy. The problem with this is it goes against all other investment advice. You look at a hedge fund, you read books by people like Ray Dalio, they all talk about diversification as the key to their success, as the key to their stability and consistency in the markets. Because ultimately, having all your eggs in one basket, even if it's not in trading and other endeavors, is quite a risky thing to do. So when you diversify, there's a few things that you have to change. First and foremost, you can't do the standard 1% per trade normally, because you're trading multiple strategies. So you need to risk adjust. Now, how I like to diversify is, first and foremost, you have long and short within the assets. Then you have groups of assets. So different archetypes. You could have some precious metals, some indexes, some singular stock, some currency, some natural gas, whatever. So you have lots of different types of assets. Sometimes they're risk on, sometimes they're risk off, depending on what's happening geopolitically. And you're trading a bunch of different things, different directions, even down to different time frames, intraday, swing trading, just a complete diversified portfolio. And you're not throwing them in there randomly and just hoping that they work well as a portfolio. You're doing lots of testing to make sure that they're uncorrelated, to make sure that when your gold positions are long, you're not shorting silver at the same time or something like that. So basically having a diversified approach to trading, following the greats. Simple as that. You're copying what the big players do. Hedge funds don't just buy Apple and Tesla. They diversify across multiple assets. And having that approach in trading has served me very, very well, and it serves our clients well as well. So consider those two things if you're consistently losing or not having the consistency that you want. First and foremost, backtest properly and make sure that you're taking every position. Again, that's very hard to do if you're trading manually. And secondly, don't follow the advice of having all your eggs in one basket. So that's it for today's video. If you enjoy it, if you have any questions, let me know in the comments, and I'll see you in the next video.